Oh, hello everyone, Susie here again from Esoteric Trading Solutions. I hope you're all well, looking after yourself, being kind to yourself, being kind to your family and friends, being kind to your putty cats, your beautiful animals, and just being kind to people in the world, just to make this a better world. There was an article I read on the weekend, the 6th of the February, I should say, and it was an article that was authored by Alistair McLeod via goldmoney.com, and I thought it was a really good article actually, and it's exactly my sentiments to what I believe is going to happen in these markets, fiat markets particularly, which are also going to affect cryptocurrency markets. As you know, the equity market, the US equity market, has literally gone up parabolic since 2008. It's gone up literally just incredible. The Dow was around 5,800 in 2008, and now we're looking at 29,452 or something. Yields are all-time lows globally. Credit spreads are at all-time narrows to government bonds and to the swap curve. And literally, asset markets, fiat asset markets particularly, if we look at the equity market, we look at corporate bonds, corporate credit, high-yield corporate credit, high-yield bonds. And if we look at the equity market and, just outright yields, everything is just so overbought. There is a real risk here that, interest rates are not reflecting the right valuation levels. That's what I believe, just simply because of what we've seen, obviously, as central bank funding in the market, quantitative easing, literally interest rates being reduced dramatically to basically, bolster this appetite of going into absolutely risky assets. And so we've seen these markets completely overflated. And this article is a very, very good article. It's got some very technical terms in there, which I'll try and explain to you. The article is an excellent read if you can get your hands on this. It's called Coronavirus and Credit, a Perfect Storm. And it really is the black swan. We call it black swan in markets, where the absolute X factor takes place, like we saw in 2008. Where you see the equity market just collapsing. And this is pretty much what this article talks about, but also what it talks about is the equity market collapsing as well as the bond market collapsing, which means yields go up rather than down, and also corporate credit blowing out to smithereens, which is exactly what we saw in 2007 pre the equity market, and high yield spreads blowing out and emerging market debt spreads blowing out, and also currency wars as such. And often when we see a US equity market coming down, we do see a dramatic selling of the US dollar, because clearly everyone's long US equities. And if you're long US equities, if you're selling US equities, you need to sell the US dollar and go back to your own currency. So obviously that's why the US dollar goes down. Coupled with this, the article mentions also the repo market. Literally, the repo market has been running out of liquidity. The Federal Reserve, the Treasury, has had to come in many times to bolster up the repo market and lend to banks, which is a real worry. And we've seen those very short term repo rates, which can be, literally they're in the morning, within an hour. A repo rate can be anything, from under 1% to 12 or 14%. It's what we saw last September. And we're seeing that again and again. And something, is seriously wrong. Even I know the liquidity markets are not what they used to be. Liquidity in the equity market, the bond market, even the foreign exchange market, with all the compliance we've seen over the years and all the regulation, there's no natural players in the market anymore. Banks used to have prop books where traders could trade on behalf of the bank's capital. We don't see that anymore, and the lack of liquidity in markets is really showing. So with regulation and everything else, a lot of banks have given up their trading books. Obviously there's no one on the other side of the deal if everyone's selling. And basically we're seeing this huge lack of liquidity in markets, in fiat markets professionally. Now what does that mean for cryptocurrency? Again, all markets are connected by cash. We need to remember that. Probably initially people will be selling cryptocurrency too, but I think within a day or so they'll realize with a day or so, they'll realise that cryptocurrency is a very, very cheap asset class out of the four other asset classes, which are clearly, debt, fixed income, property, equities, and cash. And so cryptocurrency itself is a very, very cheap asset, and every other asset class is a very expensive asset. So it's going to be very interesting. So what would happen is I think you're going to see a big inflow into the cryptocurrency market when this does happen, particularly when people start losing faith in their own domestic currency, whether it be the Swan, whether it be the Aussie dollar, whether it be the euro or whatever. And basically people start going into cryptocurrency, because the cryptocurrency is not going down as much as the devaluation of your own domestic currency. Now we've seen that in other markets as well, like Venezuela and Argentina, where the valuation of their own domestic currency was devalued to such a degree it became absolutely worthless. Government policy basically devalued, say, the foreign currency, their own domestic currency, foreign currency, 99%. So if you had savings in the bank, it would be absolutely worthless. So let's go through this article. There is a bit here, but it does talk about the coronavirus, and they're saying the coronavirus coincides with a downturn in global credit cycle, which potentially could yield catastrophic results. And I think people aren't watching this coronavirus enough. And basically, particularly with what's happening in China, does create world growth. China's had to literally close down its factories for a month or so. And, this pretty much says that the equity market and the bond market and the high yield market are way too bullish. And I have to believe, I absolutely agree with this article. I think there's a black swan coming. And I really honestly believe, I was trading and I was around managing money in 2008, and when that black swan comes, it's going to be even worse than 2008, because I believe that the old structure hasn't been fixed and markets have become less liquid because there's not as many players in the markets as there used to be, and you can see that just the way markets are actually trading. So basically, Alistair McLeod says the credit crisis was already likely to be severe given the combination of an end of a prolonged expansionary phase of the credit cycle and trade protectionism. And he's saying there's very similar dynamics going on compared to 1929-32. Okay, so he's saying there's a very, very similar paradigm, and he talks about economics and those sort of things. So if you get your hands on this article, you can actually read more of the article, but it's a fascinating article, and I really wanted to bring it to your attention. He talks about, could there be a simultaneous collapse of fiat currencies and financial assets, and will it happen again? And I think my own perspective on this is, I think that there can be, absolutely, we're already starting to see it. There's an absolute money bubble, and there's certainly a financial asset bubble that we've never seen, at any time. And he's effectively saying, could this come off, incredibly fast? And often when markets go down, they go down by the lift. They go up by the stairs and they go down by the lift. So in other words, when they go down, human panic, really, really cuts in. So, he mentions things, back in time, but, he's talking about the coronavirus, or the COVID-19. He says we know little about it. Its origins are allegedly a mutation of a virus from a snake, bat, or pangolin, which is like it's a type of cat with a hard back on it and everything else, which I've never seen one before in my life. It's specific to China. It's nearly extinct, but they tend to eat those as well as bats and snakes together. And they're wildlife, and they can sort of eat them half alive, which is awful. But this is how this virus has been able to mutate from these animals and reptiles to the human being. He says also, alternatively, one school of thought believes that it came from a biological warfare laboratory in Henan. And at the time of writing, officially the ratio of reported deaths to reported recovered is about 23%, which has been declining as time progresses. But while the fatality rate is expected by Western analysts to level out at around 3.5 to 4% of those infected, its spread is probably much more serious than admitted, with the Chinese being accused of playing down the crisis. To be fair, it would have been hard for the authorities to keep up with its rapid spread coming during the Chinese New Year holiday when most factories have closed anyway. There is some confusion about the economic impact. Officially, the public holiday ended on the 30th of January, but nearly all factories are still closed a week or two later and haven't yet opened. And not only do Chinese factories supply the world with consumer goods, but they are integral to the global supply chains. Hyundai in South Korea has already been forced to close all its factories due to a lack of Chinese components, and other car makers around the world have expressed similar difficulties. For all intents and purposes, China is shut and therefore its economy is not functioning. And the longer this goes on, it's increasingly difficult to see when, if ever, past normality will return. So this is quite alarming when you read this. Basically, it goes on to say if this financial epidemic, if this viral epidemic materializes, the financial system was already on life support and at its weakest anyway. The credit cycle is due to turn down, and the dynamics behind it suggest could be worse than the Lehman crisis in 2008 when Lehman went broke, which is broadly contained to financial entities and residential property prices. This time the banks have accumulated worrying levels of junk debt directly and indirectly through collateralized loan obligations. Okay, so they've actually gone into loans to other countries directly, and you see that with Deutsche Bank. Deutsche Bank lent out a lot of money to different African nations, and a lot of their loans have gone very bad indeed, very bad. And if other banks have done the same thing, it is very concerning, because it means that if you've lent loans to some of the poorer nations, whether it be Argentina, some of the South American countries or parts of Africa, you run the risk of not getting your money back if you're a bank. So it actually doesn't become an asset on your balance sheet. It actually becomes a liability, which is a worry. It goes on to say money markets are badly stretched, with liquidity having miraculously disappeared, liquidity having miraculously gone. Central banks are flooding them with new money even before the periodic banking and systematic crisis has occurred. But all this extra central bank money, all it does is achieve to drive up financial asset values even higher. Now that is scary, okay? It would be a mistake to blame the financial and economic environment events that follow on the coronavirus, but inevitably this is what those who have relied on failing monetary system will do. And pretty much, if this gets worse, it goes on to say that the system is literally on the edge, and there will be the timing of an emergence could pull the trigger on a global financial and economic collapse. This is really scary stuff, and I have to say I do believe this. I believe it is coming. I really do. The markets, the equity market cannot stay up where it is. Honestly, it's up there on the basis of very low interest rates, very low yields, and high yield has come down to such a degree because all this money that the central bank keeps giving them is chasing these yields, which have come down dramatically. And yet at the same time, in the repo market, there's no liquidity at all, and yields are going through the roof. Something is not right here, and something is deeply concerning. And as I said, I've been around markets for 37 years, and I've never seen anything like this. And I think when the collapse comes, it's going to be very, very bad indeed. The credit cycle and asset inflation. And yet the thing is, every government out there, whether it's statistical or not, will say that we have no inflation in the system, which is the purchasing power of our dollar. If there's inflation in the system, it means the purchasing power of our dollar gets less and less. And the reality is the purchasing power of our dollar has got less and less. But the figures that are released by the statisticians on behalf of the governments show inflation is at 1.5 or 2%, and that is just not the truth. When we look at our utility bills from 20 years ago, when we look at, the cost of housing, when we look at the cost of sending children to school, when we look at the cost of transport, the cost of healthcare, the cost of everything has skyrocketed, except things that we import from China, like white goods or clothing. The cost of everything else in our lives has gone through the roof, and I can tell you right now, it's gone through the roof in 20 years. There's just no doubt about it. And yet interest rates keep going down, and that is not right. When interest rates keep going down, but inflation is going up, interest rates in terms of the economic model should be going up as well. But the thing is being purposely kept down by central banks, and obviously by, pressure on the Fed to reduce interest rates. And this is what's caused this feast, of buying, high risk assets. And it continues and continues for the chase of high yield. And yet, the risk metrics in markets is not showing the truth, right? The risk metrics in the olden days used to be interest rates would show you the truth. If there was inflation in the system, interest rates would go up and the equity market would come down. If there was too much growth in the system, they'd start raising rates to bring the growth down so that you wouldn't have inflation. But now, this rate mechanism is just not working, okay? And that's scary in itself. He goes on to say the credit cycle and asset inflation, we should remove ourselves from the credit cycle, which is the manifestation of banking psychology. In changes in the availability of the credit is on the turn. There are 3 distinct classifications of credit demand affected: the non-financial economy, speculators, particularly large hedge funds, and governments. So, excuse me for a minute. So, basically saying the people that have money are basically taking on, the people that manage money are taking on more and more risk every day. Also, even consumers are not saving. Consumers are in debt up to their eyeballs, which is absolutely the fact. In Australia, I don't know what it's like in the US, but I'd assume it's the same. Consumers have 120% of debt to 100% of income, which means they're borrowing $120 and they only have $100 of income. And that's a scary thought, when consumers are not saving, but they're basically borrowing money and they only have $100 of income. So I've got a trade position on. I'm actually short the Aussie dollar at the moment. Looks very weak against the US dollar, very weak. So it says today in the US, UK, and many other developed economies, with the exception of pension insurance funds, savings as an economic force has virtually disappeared. The majority of consumers are now living payday, and continually in debt with respect to their current spending. Now that's a scary thing when you consider that consumers are living from payday to payday. What happens if they lose their job? What happens if they don't get paid? Does that mean they can't pay their rent? That's a very scary thing. It sounds like consumers could easily be homeless, which is even more of a scary thing. Predominantly at the expense of ordinary people, wealth and real incomes have been increasingly transferred from productive individuals to governments, the banks and their favoured borrowers, through monetary debasement. The effect of monetary debasement has been concealed by statistical methods, exactly what I'm saying, leaving consumers considerably worse off. Their slavish followers of government statistics are generally aware. And this is exactly what I'm saying about CPI, consumer price indices. They put them at low, all-time lows, and yet it's absolute garbology. Our purchasing power of our dollar has actually gone down, deteriorated over the last 20 years. Much so more. There's more taxes in it. The cost of living has just escalated through the roof. People can't even afford rent anymore. And yet, the statistics that come out are just garbology. Absolute garbology. Every credit cycle impoverishes consumers even more, as their earnings and diminishing savings are continually eroded by ever accelerating monetary debasement. Now, what they're getting at there is if the US keeps issuing more and more bonds into the market, i.e. they increase their debt ceiling continually, which means they keep increasing their borrowings from the rest of the world, which effectively, if they keep issuing bonds, it's like selling the US currency. Eventually, you're going to see US dollar weakness. That's pretty much what they're saying there. The more you keep selling your bonds into the market, the more reliant you are on the rest of the world. And the thing is, you're not paying back your debt. The debt is getting worse and worse, constantly getting worse and worse. You never pay it back. Effectively, you should be seeing your own currency going down quite dramatically. He then goes on to saying, having tamed the statistics, governments such as the UK, the US, and some members of the EU now think they can abandon all fiscal probity. And that's a bit of a scary thing. They think they can finance budget deficits, public investment projects, and even sustainable energy projects with only limited consequence for currency's purchasing power, all by inflationary means. It is, of course, all delusion with the end of a cycle of psychology. This is pretty scary stuff, seriously. But there is a crunch coming, okay? And they talk about the US repo market, where repo rates suddenly went through the roof, up to 10%, 14% by under one, such as accelerating demand and government funding that they cannot be accommodated, as well as the interest arbitrage activities of speculators active in repo and foreign exchange, FX swaps. So, in other words, the repo market is struggling to keep its rates under 1%. And the repo market, because there was such pressure for banks to borrow in the morning because they had no short-term funds, the repo rate went up to 10, 15%. And the Federal Reserve had to come in, the Treasury had to come in and lend money to the repo market. It wasn't enough that they normally do repo, they had to lend additional money. Now that's a bit of a scary thing. It makes sense too, because when you think about it, if all the money that's been created by the Federal Reserve has gone to the banks and they've lent that money out to loans to every other country in the world, or high yielding assets which have a maturity that's longer, the maturity might be 5 years or 10 years or 3, then their short-term funding, it makes sense. It means they don't have money for their short-term positions. And this is what we're seeing in the repo market. Okay? This is what we're seeing, and that is scary. So that's pretty much what they're saying. I won't go into the swap mechanics. It might be a bit too much for you guys, but it effectively means that if there's no money in the repo market because every bank has lent out long and they've got no short-term funding, the Reserve Bank of Australia or the US Central Bank has had to come in and lend money to the repo market. Okay? So also this article goes on to say that there's a massive number of swaps and FX forwards being done, chasing higher yields, so borrowing from lower rates and chasing higher yields. So for example, borrowing from the euro lower rate or the negative rate and going into a higher rate being, say, the US rate. And so all the market is positioned the same way, and you can see this. So derivatives grew from 53.9 trillion to 59.4 trillion in the first half of 2019. I mean, that's massive. A massive derivative position. If everyone's the same way, what happens when they unwind these? It's going to be unbelievable, because they're going to unwind these things and they're going to be effectively selling US asset positions and going back into euro, literally. So it's just a matter of time. So also, primary dealer subsidies of GSIB okay, so basically then he talks about then he goes on, actually exactly what I said. There's important banks in the world which are globally systematic important banks under Basel III rules, okay, which are too big in terms of what the Fed saying, and Basel and everything else, too big to fail. They recognise them as being very important banks in the scheme of things, and they had very restrictive conditions to what they have to report and everything else. So if we look at those banks, there's a whole list of them: Mizuho, Sumitomo Mitsui, Bank of China, all these, right? And it goes down and down and down, right? And you can pull that off. These banks have high regulation, high capital requirements and all sorts of things because they're deemed as being banks that are too important to fail. But the thing is that we're finding that these banks are having trouble in the repo market. This is a bit scary. It goes on to say that these banks are reliant on the Fed repo, and literally they act as a pass-through to the speculating hedge funds. In effect, the Fed is directly supporting the speculating hedge funds in their activities as now the primary agent behind the inflation of financial asset prices. Now, if you believe that, that's a very, very scary thought. And clearly we've got the proof of that because whatever's going on, we can see it in the repo market, which is very, very scary indeed. Okay, and we can certainly see it in asset markets, which are severely in overvalued territory. And this is exactly what this says. The Fed's policy of inflating financial assets has taken them into severely overvalued territory. And I have to absolutely agree with that on every level. Every level. Very, very scary. So, meanwhile, the tranquility of financial markets everywhere belies this biggest challenge yet. The impact of the coronavirus on China's economy and therefore the global economy should not be lightly dismissed. Even if it does not become a pandemic, defined as an epidemic across national borders, it comes at a time when the global economy is entering the crisis stage of the latest credit cycle. The fact that these two events have also coincided with a collapse of cross-border trade brought about by Mr. President Trump's tariffs against China, given an added viciousness to the situation. Even without the virus, the similarities with 1929 leading to the Wall Street crash and the subsequent economic depression should give thinking investors considerable pause for thought. And I agree totally with that. And I see the cracks and it really scares me. Let's what else see what else he says here. There's a lot here. But yeah. I mean, basically China, needs about 8% GDP growth to keep their people employed, because it's such a big country. To take their people out of agriculture or out of peasantry, if you want to call it that, into being employed in the lower middle class. Now, they don't get 8% gross domestic product. They can't actually do that. And what we're seeing is with China before this coronavirus was gross domestic product at 6%. So it means that they're not able to employ, get people lifted out of poverty into a job or anything like that. And with the shutdown, it means that their gross domestic product is going to be even lower and lower. Plus, with protectionism, which is what we saw in the 20s leading into the Wall Street crash, protectionism of traded goods. In other words, huge tariffs on, say, Chinese imports, which will slow down the growth of China and have effects on every other country in the world. It is really concerning when you look at the economics of that. Very concerning. It goes on to say the signal that all is going wrong for the yuan, which is the Chinese currency, it's sometimes known as a renminbi, is likely to be reflected in the demand for Bitcoin, which can be bought online through peer-to-peer marketplaces, even by partners under quarantine. China's Bitcoin exchange was shut down by the government in 2017, but at the time of writing, they were trading at a small premium to the dollar price. If that premium increases or the number of bids suddenly jumps, bids means buy, it will be an indication that the Chinese residents are beginning to lose faith in their currency. Now, don't forget, their renminbi or yuan has devaluated quite dramatically against the US dollar. Okay, I think it's trading near 6 now. So every time something happens, they've had to put massive amounts of injection into the economy, and also they've had a big devaluation in their own renminbi or their own yuan, which means they can buy less goods overseas. It's going to cost them more to buy goods overseas because their own currency is devaluating. And the thing is, this says if a currency devaluates more than, say, the price of Bitcoin, which is holding its value or a store of value, then people are more likely to go into Bitcoin. And we've seen that in every country in the world where there's been devaluation, like the Turkish lira. We've seen it in Iran. We've seen it in other countries where the currency is worth nothing. Even a lot of Africa, right? There's a lot of buying of Bitcoin just simply because people don't trust their own domestic currency anymore because of what governments do with failed fiscal policy and just failed economic policy, which has been an absolute disaster in many, many economies of the world. So it says keep an eye on Bitcoin prices, certainly. If they're trading at real premiums in different markets, because that really is the test. Even without the coronavirus spreading to other nations and undermining their economies directly, those who believe in the efficacy of their central bank's monetary policy will begin to have doubts, as not even negative interest rates have succeeded in stopping an economic decline. And I tend to agree with that as well. If you look at gross domestic product rates, they're very low all over the world, and I can't believe the International Monetary Fund thinks that growth rates worldwide should be around 2.5%. Growth rates in my mind are well below 2%, and with China having this literal close down of all their factories in the Wuhan area, which has got at least 14 million people or so, in other areas where it's spreading, it's going to absolutely reduce growth for everyone, pretty much. Also Australia and other Asian countries as well that really rely on the Chinese spending in their countries, particularly with tourism and everything else. So I can tell you right now, Australia's growth is going to be quite low in the next 6 months going forward, which is also at the moment having an effect on the Aussie US dollar. And that's why I'm selling it against the US. It has depreciated quite a lot against the US in the last month or so. So the greater danger for the Americans is a realization with global economic slump that cannot be denied. Overvalued stock prices are vulnerable to a major fall. At the same time, there is likely to be a sharp reassessment of the government's borrowing requirements. At that point, the link between overvalued stocks and unrealistically low government bond yields can only lead to one conclusion. Reliance on unlimited quantitative easing as a means of funding government spending will appear endless. So again, eventually it's all going to fall down, like a pack of cards. And essentially it's going to be shown in the currency as well. So this article is pretty much saying, look out, it's coming. I tend to believe with it. It's going to be a black swan, even though they're so beautiful, but it is coming. When you look at where the Dow is, where it's gone, I mean, it's just straight up, right? If we look at this, look at it over, put in all, this is just crazy. How far can this keep going? I mean, it's just been absolutely parabolic, straight up. We look at it since, this is 2008, and it's just gone whoosh. And you've got literally every credit market looking so expensive, every high yield market looking expensive. Negative interest rates or extremely low interest rates are driving up any yield asset because people are just chasing yield. And eventually this is all going to come down like a pack of cards. And I agree with that article. Anyway, guys, just very much food for thought. I think, I done economics, it was my first degree, major in economics, and I love it. And I just think there is a real risk in these markets, absolutely. Ultimately, it will be good for cryptocurrency markets because cryptocurrency markets shouldn't correlate with the fiat markets at all, except probably gold. Okay, so anyway, food for thought. Hope you're all well. Please look after yourself. Please be kind to yourself. Please be good to your family, your parents, your putty cats, your beautiful animals, and please be good to people in the world. There's just so many horrible people in the world. Let's just make this a better world for everyone. Thank you very much, guys. Please look after yourself, and thank you for listening.